According to Jeremy Grantham, the U.S. is shockingly overpriced, not moderately overpriced. I believe they'll do well by selling whatever they do. Get rid of the terrible lust to participate in profit-making that arises at the end of every major bubble. It's very seductive and hard to resist. I was there a few decades ago, made a fortune, and whited out very well. I would wish on most of you that you avoid it because it ticks all the boxes and has completed all the usual actions of a super bubble. And maybe a month ago, it requires a long bull market minus 11 years is the longest in history. A lot of crazy behavior, and we experienced some of the greatest crazy behavior ever. I believe I'll be sharing these stories in 20 years. At the end of a bubble, it needs to accelerate at a rate that's roughly 3 times the average rate of the bull market, and it did that from then on out. The Nasdaq more than doubled and increased at a rate that was well over 3 times the average rate. Lastly, a feature that is specific to the super bubbles, 2 or 3 that just keep going, is that at the end, even on market upswings, speculative stocks begin to sell off, and that began early last year when the very best of them all began to decline. One by one, they fell in and began to decline. And as of right now, roughly 40% of all Nasdaq stocks have lost over 50% of their value. That is quite remarkable, considering that just the other day the S&P reached its all-time high. Nothing in life is guaranteed, but I believe that this marks the start of the burst, which occurs when the very best performing stocks start to decline as the market rises. At the real estate market, we'll fight it out. The global real estate market is extremely high, and the bond market is similarly high, with interest rates at an all-time low. However, the stock market, like the tech bubble and the year 2000, is primarily an American affair. While it is often overpriced, it is not particularly dangerous in the U.S. because of our extreme overpricing and insane behavior, and I believe we are in a rather dangerous equity bubble. As a result, there is a good chance that Australia and the UK will experience similar risks. Japan has a few countries with relatively affordable prices. If they decline in unison, they will likely decline much less and rise sooner. This U.S. bubble is comparable to the tech bubble of 2000. It is driven by the Nasdaq and the Specs 2000. Since the S&P has been rising while the specifications have underperformed the entire year, it is possible that the S&P may rise to a new high. However, I don't think it is possible. Thus, I believe the game has begun, and it will likely unfold similarly to a 2000. The stock market has always detested inflation because it drives down price-earnings ratios. However, this time, unusually, inflation did not start roaring through the ceiling as PEs kept rising. Nothing like that had ever happened before. We have a model that dates back to 1925, and it shows that price-earnings ratios, or the level of the market's price, are determined by 2 factors: profit margins, which the market naturally loves, and inflation, which it naturally hates. These factors have worked like charm, setting world records for profit margins at the top of the market in 2000 and today, with relatively high inflation, meaning that the market should have started to decline in the middle of last year had it been following the usual battle plan. In the end, the Fed doesn't like to get on the bad side of the administration politically. The average person in the street notices that inflation is death. If anything, it is exaggerated. But even without exaggeration, it is painful and politically very tough on the voting pattern. Therefore, the administration really wants to do everything it can to get inflation down. The market is saying about inflation that it completely ignores. It believes that it's temporary, ephemeral, etc., and it doesn't appear to be. Should that permeate the market in the typical manner, the price-to-earnings ratios will be severely suppressed. Thus, it will be tactfully depending on the Federal Reserve to take appropriate action. Some individuals have dedicated their entire lives to following the Fed and understanding the subtleties of quarter and half points, but I do not. I am convinced that the Fed will err on the side of caution and work diligently to prevent inflation from becoming entrenched. However, I also know that this will be challenging given the scarcity of labor and the rising wage rates that will be implemented in the U.S. over the coming months. Thus, it will be difficult, and the Federal Reserve will need to raise interest rates significantly if you must own U.S. stocks. You should, however, own high-quality stocks that are in good financial standing, as these can always turn into financial crises. I would also like to emphasize that, generally speaking, non-U.S. stocks and quite a few countries are not that bad. Although the high price of commodities is a mixed blessing for emerging markets, especially if the U.S. withdraws, the advantage of low prices usually outweighs all other considerations. Thus, investing heavily in U.S. stocks would not be a good choice compared to investing in some of the less expensive developed nations, such as emerging markets. I believe it is coming to an end. I'm working on a paper that essentially explores the story of Goldilocks and the three starving bears, or the end of the Golden Age. Over the first 20 years of the 21st century, everything changed. Profit margins averaged 30 to 35% higher, and the PE average increased by 50 to 60% compared to the previous 50 to 60 years. Corporations gained significant political clout, and capital gains taxes decreased. Dividend tax, interest rate tax, capital gains tax, things fell apart. The majority of the regulatory agencies were partly taken over by businesses, and they enjoyed a golden age during which their earnings were never higher. The monopolistic nature of our economy today, and to some extent around the world, has increased due to the concentration in each industry and the notable companies that have become instant monopolies in their own right. While this is great for profits, it is not so good for growth, and governments are starting to become less valuable in my opinion. I believe that they incorporate technology that, like the internet, may prove to be useful here, there, and everywhere. When they are profitable, you value them like any other business venture, but in the meantime, they just sit there and increase in value because people believe that they will. It's essentially a matter of perception. In particular, I believe that Bitcoin does no good and is being replaced by a whole new generation of more intelligent and efficient cryptocurrencies, many of which do not generate revenue in the conventional sense, and a select few do. I have no doubt that the concept behind cryptocurrencies will last forever, but I also have no doubt that the majority of their current perceived worth as a store of wealth is a fraud. Everyone can agree that the volatility of these assets is extreme, rising and falling along with high-risk stocks. Since this isn't the fundamental idea, what use is a store of value that trades like a hypersphere? Value has always been you pay for what you receive, and gold, in contrast to many thousand years of practice, has remained boringly consistent over the previous couple of years. I should know because I earned some. I have always felt that the best definition of value is a dividend discount model that projects earnings into the future and discounts them back according to quality, with high-quality companies having a lower discount rate than junky companies. This is why I'm not a big believer in price to book, especially since book as an accounting entry has been extremely distorted in the last 20 years. However, not too long ago, we studied the regression rate by type of company and tried to work out on a company-specific basis. Given their unique characteristics, we calculated the regression rate that each of them would have if they behaved normally. As a result, we kept Microsoft in our value portfolio throughout the 1990s. We didn't phase it out until June 1999. By then, we had 12 monthly slices. By June 2000, we had completely eliminated Microsoft before the company faced a financial crisis. Using those models, you can see, for instance, that emerging markets are incredibly cheap, relatively speaking, as cheap as they have ever been, when compared to one or two other occasions. However, if anything, they are even somewhat less expensive in comparison, and you can see that they are really not that bad at all. That is the group for which the absolute price appears enticing. And I can expect this because I hear it so frequently, naturally. There are always a lot of questions about emerging markets, risk, quality, currency, and so on. And it's true that these questions have always existed, but these markets are extremely diversified. For example, the index comprises 28 countries, with China accounting for 40% of those, making China the world's largest economy. In terms of inflation-adjusted dollars, India is growing significantly faster than the U.S. alone this year. They've also opened up a further 10% GDP gap. Currently, it stands at -4 and +6. As you can imagine, the rest of the world believes that India will have to bear the brunt of nearly one-third of global growth on its own. Interestingly, India was growing faster than China before the recent virus struck, and it was on the verge of becoming a massive economy. Finally, there's Brazil and other intriguingly riskier countries. It truly is the future in a world where the developed world's growth rate, which has been steadily declining for 40 years, is finally slowing down. When I arrived here, the productivity per person hour was roughly 3% annually. Now, it is down to 1%, and one would be lucky to be employed in Europe. Thus, growth is not what it was. Additionally, the U.S. will experience negative growth in 10 years due to the increase in the workforce, which was 1% annually when I arrived. For the past 15 to 20 years, Japan's workforce growth rate has been negative, and Europe is also experiencing negative growth. We are experiencing a baby without parallel throughout the world in the developed markets. So we will have to get used to a GDP growth that is much less than we anticipated. There will also be a premium on growth, and emerging markets will have far greater top-line revenue than the developed world. At 1.0 fertility when replacement is 2.1, South Korea's fertility rate is far lower than China's. It's difficult to comprehend that half of the baby cohort is lost every generation. That is, every 30 to 35 years. That is, Italy is 1.4, and Japan is 1.4. China is a dismal 1.5, 1.55, whereas the U.S. is 1.70. Italy and Hungary are in the mix, and the population growth rate of Europe will be very similar to China, possibly a little bit higher, but not enough to count. The U.S. will not have a growing labor force, and it is highly unlikely that we will accept enough immigrants to prevent a decline in the baby cohort at 1.7. You're running 15% or more below replacement. We haven't accepted that level of immigration in years, and we're not sure how the numbers will hold up in the future, let alone expand to zero. However, over the next 50 years, the U.S. workforce will drop at a slower rate than that of Europe and China, and naturally far more slowly than that of the developed world, which will make the U.S. one of the more alluring aspects of the other 60%. Therefore, China will have a declining labor force while the other 60% will see an increase in labor force, placing them far ahead of the developed world in this regard. Avoid difficulty and be sure not to purchase pricey marketplaces. Costly stocks highlight value for money. Look for the less expensive nations. Look for the less expensive stocks inside such nations. Maintain a small cash reserve at the end of every major bubble. There are often some very nice buying opportunities. However, I would advise most of you to avoid this terrible lust to participate in profit-making out of fear of missing out on something. It is very seductive and difficult to resist. As we wrap up this deep dive into Jeremy Grantham's prescient warnings about the impending market crash, it's clear that his insights should not be taken lightly. Grantham, renowned for his sharp foresight and profound understanding of market dynamics, emphasizes that this crash will not just be another economic downturn, but a pivotal event that could reshape the financial landscape for an entire generation. His analysis suggests that the excesses of the past decades, from ballooning asset prices to mounting corporate debt, are setting the stage for a significant correction. This crash, he argues, will force a recalibration of investment strategies and economic policies, making it crucial for investors to stay informed and prepared. For investors, especially those new to the market, Grantham's message is a wake-up call. It's a reminder that markets are cyclical and that periods of exuberant growth are often followed by sharp downturns. The key takeaway is to adopt a long-term perspective, focus on fundamental value, and be wary of speculative excesses. Grantham advocates for a disciplined approach to investing, emphasizing the importance of diversification, risk management, and patience. In light of these insights, it's essential for every investor to stay educated and vigilant. Keep learning, keep questioning, and don't be swayed by short-term market noise. Remember, successful investing is not about timing the market, but about time in the market. If you found this analysis insightful and want to stay updated with more investment strategies and market insights, make sure to hit the like button, share this video with fellow investors, and subscribe to our channel, Investing Tutorial. Your support helps us bring more valuable content to help you navigate the complexities of the financial world. Thank you for watching, and stay tuned for our next video where we delve deeper into the intricacies of investing and market dynamics.